Welcome to the Deep Dive, the place where we take complex, often contradictory source material financial statements, strategic analyses, deep research reports, and distill them into the pure, actionable insight you need to stay ahead. Today, we are wrestling with a giant of the cloud software world, Salesforce, ticker CRM.
And this isn't just, another earnings report deep dive. This is about analyzing a fundamental shift for a company that was, for a decade, really synonymous with the hyper-growth ethos of Silicon Valley.
Right, the whole growth at all costs mantra.
Exactly. The core tension we're dissecting is immense. How does a $38 billion annual revenue business maintain relevance and continue growing when its core market customer relationship management is undeniably maturing?
And that's not even the biggest question.
Not even close. The bigger one is, how do they navigate the internal threat posed by agentic AI, their own agent force initiative, which, it fundamentally threatens to cannibalize their traditional license-based business model.
That's the entire mission for us today. We have a comprehensive stack of financial and strategic documents detailing their Q3 fiscal year 2026 performance. Our goal is to unpack this trade-off between hypergrowth and profitability, and most importantly, to evaluate the true risk and potential reward of this massive multi-billion-dollar bet they are placing on Agentforce.
And for you, the listener, this isn't just about Salesforce. This is a definitive case study in how every enterprise software giant is going to try to survive the transition into the AI-native economy.
So we're framing this entire discussion around what has broadly been dubbed the year of efficiency.
That's the term. Salesforce has definitively abandoned the old mantra of growth at all costs and committed to profitable growth. Yep. This quarter's report is truly a bellwether for the entire enterprise software sector. It's signaling that discipline is the new priority, and a lot of that is being driven by activist investor pressure. We need to see if that discipline is, structural and sustainable.
Okay. Before we dive into the data, a quick but crucial reminder for everyone. The analysis we discussed today is based on publicly available sources and is strictly for educational purposes only. We are simply dissecting data for insight.
And it absolutely does not constitute investment advice. You must always conduct your own due diligence before making any financial decisions.
Right. Okay, let's unpack this with Section 1, the new reality. This really marks Salesforce's transition from a high-flying growth stock to what looks much more like a mature financial machine.
A cash machine.
A cash machine. Let's start with the headline metrics for Q3 FY 2026. What do the top-line numbers tell us about the current state of revenue growth?
Well, the headline figures signal stability, but also maturity. Total revenue was $10.26 billion.
Okay.
That represents an 8.6% year-over-year increase, which comes out to about 9% in constant currency.
So sub 10%.
Some 10%.
Yep.
And look, 9% growth on a nearly $40 billion annual revenue run rate is fundamentally healthy. That's a huge number. However, for context, you have to remember that Salesforce historically targeted and often hit 25% or even 30% annual growth back in the 2010s.
So this sub 10% figure is a stark, undeniable departure.
It's a different company. The narrative has clearly changed. They hit their expectations, which shows consistency, but this is no longer a company that beats and raises revenue guidance by, double-digit margins every single quarter.
So what's driving that slowdown? Is it just the law of large numbers, or is there something else at play?
It's a few things. One, yes, the sheer scale of the business makes 20% plus growth mathematically almost impossible without some revolutionary new product. But two, and this is maybe more important, it reflects intense IT budget scrutiny across the entire enterprise world. Companies are being highly selective about where they allocate capital.
Right, so the must-have projects get funded, but the nice-to-haves are on the back burner.
Precisely. The high-margin, low-churn projects get the green light, but those expensive, non-essential expansions are delayed. Salesforce is feeling that.
But the quality of this revenue, the recurring nature of it, that remains top tier, right?
Absolutely. This is the saving grace, and it's the foundation of their whole moat. Subscription and support revenue hit $9.73 billion, which was up 10% year over year.
And that's what, 94% of the total?
Crucially, yes, that forms 94% of the total top line. This fact cannot be overstated. The vast majority of Salesforce's revenue is recurrent, predictable, and highly stable. That foundation enables everything else we're about to discuss regarding profitability.
Okay, so let's turn to that. This was the defining theme of the quarter, the profitability breakout. The market was expecting strong profits, but this was something else.
They smashed it. I mean, there's no other way to put it. Non-GAAP diluted earnings per share, or EPS, hit $3.25.
And the consensus was what, 280 something?
The analyst consensus was $2.86. So they blew past it by a staggering 13.6%. This margin expansion is where management just executed flawlessly. It proves they can flip the switch from growth spending to efficiency.
And historically, we've always had to talk about the huge elephant in the room with Salesforce, this massive divergence between the non-GAAP numbers and the reality of the GAAP numbers.
The stock-based comp problem.
The stock-based compensation, exactly. That gap used to be enormous.
It was a massive point of criticism for years. Salesforce was famous for having nearly zero GAAP earnings because of exorbitant stock-based compensation, SBC. And some analysts argued pretty convincingly that it was masking the true cost of employee retention and all those acquisition-related expenses.
So what does that gap look like now? Is it still a huge red flag?
It's narrowing. It's still there, but it's narrowing. This quarter, GAAP diluted EPS was $2.19.
Right, so still a $1 difference, but on a bigger base.
Exactly, and that's the key insight. As the overall revenue scale, the denominator, increases to over $10 billion per quarter, the high SBC, while still a significant cost, is becoming less obscuring of the underlying profitability.
So SBC hasn't necessarily dropped to zero, but the company has just grown so much faster than the SBC expense that the overall dilution impact is less significant to the bottom line.
That's a perfect way to put it. It's a scaling effect.
Yeah.
They are finally growing into their cost structure.
Let's move to structural margin expansion, because this wasn't just about a round of layoffs, which they certainly undertook. This represented a deeper structural commitment to discipline.
It absolutely was structural. This is not a one-time thing. If you look at the figures, non-GAAP operating margin expanded significantly to 35.5%.
Wow.
And even the reported GAAP operating margin climbed to 21.3%, which is up substantially from 20.0% in the prior year. This is a dramatic, sustained improvement.
And you're saying this doesn't just happen by accident?
No way. This is a direct, calculated response. The expert insight here is that this is the visible result of those intense activist shareholder campaigns they endured in 2022 and 2023.
So the activists basically forced their hand.
They forced them to get disciplined. Management has committed to prioritizing discipline, cash flow, and margin over, expansive vanity projects or reckless M&A.
But isn't there a risk that this structural change, driven purely by activist pressure, starves innovation? How do we know they haven't cut into the muscle instead of just the fat?
That is the critical question. That's the bear case, right?
Yeah.
The argument against them is that cutting sales and marketing, or S&M, too hard will eventually choke off the pipeline 3 or 4 quarters down the line.
Right, you can't see the damage immediately.
Exactly. But the initial evidence suggests they cut the fat. They reduced spending on excessive real estate holdings, a classic Silicon Valley expense, and they rationalized sales territories. That means they optimized the structure rather than just firing top performers.
And what about R&D? That's the real muscle.
R&D spending, while it's been controlled, it hasn't collapsed. That suggests they are protecting the core muscle that drives the agent force innovation. This whole shift is allowing the inherent high-margin characteristics of elite cloud software to finally show up on the P&L.
And the ultimate marker of quality in a mature software company isn't just margin, it's cash flow. Which brings us to the cash flow engine. This was incredibly strong.
It was the bedrock of the entire investment case now. Operating cash flow surged 29% year over year to $1.98 billion.
Almost $2 billion in one quarter.
But the number we really focus on, the one that matters most, is free cash flow, or FCF. That's the cash left over after capital expenditures that can be used for buybacks, dividends, or debt reduction.
And what was that number?
FCF reached $1.78 billion. That's a 30% increase.
And the FCF margin, that tells the real story about the efficiency of the underlying model, right?
Exactly. That FCF margin recovered robustly to 21.2% this quarter. And if we look at the trailing 12 months data, the TTM data, which is a smoother metric, Salesforce is converting nearly 33 cents of every single dollar of revenue into free cash flow.
33 cents. That is elite.
It's elite tier software economics. It rivals the best in the industry. It proves their pricing power. And the recurring nature of the business allows them to generate just immense cash leverage as revenue matures.
Okay, we've established that the new reality is stable revenue and powerful profitability. But to understand the sustainability of those profits, we need to look under the hood at the core engine of the business. Let's dive into Section 2, the foundation, the moat, and the revenue stack, starting with Salesforce's history as the SaaS pioneer.
It's hard to overstate their importance. Salesforce fundamentally changed enterprise technology. They are the pioneer of the software as a service model. They moved complex customer relationship management tools off of these expensive, proprietary on-premise servers and into a pay-as-you-go subscription model delivered over the internet.
They started with just sales, right? Salesforce automation.
That was the beginning. But their strategic vision led them to evolve into this comprehensive Customer 360 unified data platform.
The Customer 360 platform, for listeners who aren't in IT procurement, what is the core value proposition? What does a massive corporation get when they sign a $100 million deal with Salesforce?
The core promise is eliminating data silos. In a typical large enterprise, customer data is just fragmented across dozens of systems.
Oh, it's a mess.
A total mess. Marketing automation is in one place, sales tracking in another, and customer support history is in a third, and none of them talk to each other.
Right.
Customer 360 aims to be the single, unified source of truth for all customer interactions. This allows the enterprise to manage every single touch point on one integrated platform.
From the first ad click to the final support ticket.
The whole journey. And financially, that model is just beautiful for Salesforce.
How so?
It is a financial masterstroke. They lock customers into multi-year contracts, and critically, they typically bill annually in advance.
Annually in advance.
Which creates a highly favorable negative working capital cycle. Essentially, customers are paying Salesforce cash today for services they will receive throughout the next 12 months.
So it's an interest-free loan from their entire customer base.
Exactly, and that's what fuels their massive cash flow generation.
Let's break down that powerful recurring revenue engine. We know 94% is subscription and support. How does that pie chart look today? What are the big pieces?
The composition has actually shifted significantly over the years. It reflects changes in customer priorities and, the maturity of the products. We can divide the subscription revenue into 5 key segments.
And I think a lot of people listening probably still assume Sales Cloud is the largest, just given the company's name.
It used to be, but that's not the case anymore. The most important shift is that the Service Cloud is now the largest revenue contributor. It makes up roughly 26% of subscription revenue.
And Service Cloud is for call centers, support teams.
Call centers, field service, digital support operations, all of that. Its success really highlights that companies realize customer retention is often cheaper and more important than customer acquisition.
And Service Cloud is incredibly sticky, correct?
Beyond sticky, it's mission critical. It's integrated deeply into the daily desktop workflows of thousands and thousands of service agents. If Service Cloud goes down, support operations cease.
The phones stop ringing.
The phones stop ringing, customers are lost, and revenue stops. That level of integration makes ripping it out a business-stopping risk. It's just not going to happen.
So where does the original foundation, Sales Cloud, stand now?
Sales Cloud sits slightly behind Service Cloud now, at about 23%. It's still the foundational product, the system of record for managing leads, pipeline forecasting.
The core CRM function.
Core CRM. And while its growth has matured and decelerated, contributing to that overall 9% growth rate we talked about, it remains the primary entry point for many new Salesforce customers.
Then we have the segments that are more about technical lock-in and customization, right?
That's the platform and other segment, which represents about 20%. This includes Force.com, their proprietary programming environment where enterprises build custom applications, automations, and workflow tools.
And Slack is in there too.
Slack is in there too, serving as a collaborative front end. But the Force.com element is crucial for lock-in. Once a customer has 50 or 100 mission-critical custom apps built on Salesforce's architecture, migrating that entire technical debt to a competitor becomes a project of such complexity and cost that it's almost always deemed infeasible.
You're stuck.
You are completely locked in.
Okay, what about the connective tissue, the glue that holds the Customer 360 vision together, especially when customers have all this external data in places like SAP or Oracle?
That's the integration and analytics segment, about 16% of the pie. This is the strategic layer built around the large acquisitions of MuleSoft and Tableau.
And MuleSoft is the key one here, right?
MuleSoft is the absolute key. It's the integration middleware that pulls data from all those disparate systems, SAP, Oracle, old mainframe systems, and pushes it into the Salesforce Data Cloud. Without MuleSoft, the Customer 360 vision is just a collection of disconnected software tools. This is the plumbing that makes the entire platform defensible.
Okay, and finally, we have the most competitive segment.
That would be marketing and commerce, which is around 15%. This covers things like email automation, personalization, e-commerce storefronts. This area faces intense competition from specialized marketing technology firms, major ad tech players like Adobe, It's a tough market.
And I see about 6% is professional services.
Right. That's the lower margin consulting and training work. They basically tolerate it because it accelerates the adoption of their high margin software.
Okay, so that detailed pie chart leads us naturally to the concept of their competitive advantage, the wide economic moat. The source material describes this as a tripod of structural advantages.
Yeah, Morningstar correctly designates Salesforce with a wide economic moat. And that's a big deal. It means they possess structural competitive advantages that are expected to last for 20 years or more.
Let's start with the anchor, which is usually the most powerful moat source for a company like this.
The anchor is, without a doubt, high switching costs. We've already touched on this with Force.com and Service Cloud. Salesforce is the system of record.
So for a Fortune 500 company, moving off Salesforce isn't like switching your email provider.
Not at all. It means not just moving petabytes of data, but migrating or rewriting years of complex custom logic, retraining thousands of employees, and risking massive operational downtime during the transition.
The risk is just too high.
The financial and reputational risk of a failed CRM migration is so high that the incumbent advantage is nearly insurmountable. Data entanglement makes leaving almost a non-option.
And the second leg of the tripod is the ecosystem, the scale advantage.
That is a textbook network effect created by the App Exchange. It is the largest B2B app marketplace in the world, period.
And that creates a virtuous cycle, right?
A perfect virtuous cycle. It's self-reinforcing. Developers build the proprietary applications on Salesforce first because that's where the 150,000 enterprise customers are. And conversely, new customers are drawn to Salesforce because it offers the widest, deepest library of pre-integrated solutions that address their niche industry needs. Competitors just cannot easily replicate that scale of third-party support and integration.
Okay, and the future of the moat, the third leg, is data gravity, which sets the stage for their entire AI strategy.
Exactly. The final leg is data gravity and AI. Salesforce realized years ago that to win the AI race, they couldn't just have a generic LLM. They needed proprietary, high-quality, trusted data.
And that's where their data cloud strategy comes in.
Right. It centers on ingesting and harmonizing all this customer data, internal and external, into what they call a golden record.
Let's expand on that golden record concept. What is the technical challenge of actually achieving that? Because it sounds simple, but I'm guessing it's not.
The challenge is enormous. Imagine a single customer. Their email address is spelled 3 different ways across your sales, service, and e-commerce databases. Their name is different. Their address is slightly different.
A complete mess.
A total mess. The golden record process, which is often enabled by that MuleSoft plumbing we talked about, is the technical harmonization layer that dedupes, cleans, and standardizes all that fragmented data to create one unified, trusted profile.
Okay, and that clean data is the fuel for the AI.
It's the rocket fuel. This proprietary harmonized data layer is then used to train Agentforce, their specific domain-aware AI models. This data integrity becomes a massive defensive barrier. Generic, open-source, large language models just cannot match the accuracy and specificity of an AI that's been trained on a company's own unified, curated history of every single customer interaction they've ever had.
So if the golden record is the moat, then Section 3, the AI imperative, is the offensive strategy that they hope will secure their future. Let's talk about the explosive growth figures they just released for Agentforce.
This is the narrative centerpiece. This is everything right now. Agentforce is management's direct answer to the bear case, that AI will simply reduce the need for human software seats.
They're trying to prove that AI creates new monetizable digital labor.
That's the goal. And the numbers so far are validating that customers are betting on this transition.
Okay, let's quantify the momentum. What are the numbers?
The momentum is, frankly, staggering. The combined annual recurring revenue, or ARR, for Agentforce and the foundational Data 360 portfolio reached nearly $1.4 billion.
Okay, and the growth on that.
That's 114% year-over-year growth, but the truly staggering figure is the standalone Agentforce ARR, just the AI piece. That has now surpassed $500 million.
Wow, $500 million already, and the growth on that piece.
It's growing at an explosive rate of 330% year-over-year.
330%. Okay, $500 million ARR growing at 330% is not a pilot program. That is a serious business line that has exited the experimental phase.
It is a real business.
But let's pause here. Can you give us some context for that number? How does 330% growth compare to their historical Sales Cloud growth at its peak? And what does it tell us about the timeline for this new revenue stream to become truly dominant?
That's a crucial comparison. Sales Cloud, at its absolute peak of hypergrowth, might have sustained 40% to 50% year-over-year growth for an extended period. 330% is a phenomenon you only see during the absolute infancy of a truly transformative product category.
So it's validating the hype.
It validates 2 things. First, the market's insane urgency to adopt AI, and second, the stickiness of Salesforce's data layer customers trust their data with Salesforce enough to build AI on top of it.
But there's always a but.
The but is that Agentforce is starting from a much smaller base. $500 million in ARR is only about 5% of their total subscription revenue. So while it's explosive, it has a long, long way to go before it can offset potential deceleration in the remaining 95%.
And to ensure it can offset that deceleration, they have to change the way they charge for things. This transition in pricing mechanics is arguably the most vital strategic move they've made in years.
It is absolutely fundamental. Salesforce historically relied entirely on the legacy user-based model, a flat fee per user per month.
Simple, easy to understand.
Simple. And it works beautifully when human headcount is expanding. But if a customer reduces headcount, Salesforce's revenue shrinks. The new imperative, driven by Data Cloud and Agentforce, is the new hybrid consumption-based model.
Okay, explain the mechanism of that consumption model in detail. How does it work?
They are decoupling revenue from human labor. The new model charges based on usage metrics: credits consumed, tokens processed by the AI, or data rows accessed and processed by the AI agents.
So it's like a utility.
Exactly. If an Agentforce AI autonomously resolves 10,000 customer tickets, Salesforce monetizes those 10,000 actions via consumption credits. This is how they capture value from digital labor, regardless of whether a human rep became 50% more efficient or was replaced entirely. The consumption model ensures that the more productive the AI is, the more revenue Salesforce generates from its existing customers.
That's the strategic defense, the bull case. But let's look at the flip side, the true existential threat. Seat compression. This is the risk that the market is clearly pricing in, as we'll discuss later in the valuation section.
This is the most complex and debated structural risk facing the company. Let's just follow the logic through. If Agentforce increases the efficiency of a human service cloud rep by, say, 50%, the customer's chief operating officer looks at the bottom line and decides they only need 70% of the headcount they used to. They reduce their licenses by 30%.
So just like that, Salesforce immediately loses 30% of its stable, predictable, legacy human license revenue.
Exactly. And if Salesforce cannot monetize the AI consumption, the digital labor revenue from the tokens and credits at a rate that fully offsets that lost human license revenue,
then the whole business shrinks.
then the total addressable market, the TAM, for their core offering, faces a terminal long-term decline. No matter how technically successful Agentforce is, if it simply makes the old business smaller, the investment thesis completely fails.
And there is a short-term pressure point within this, which the source material calls the Agentforce air pocket. What is that?
The air pocket is a timing mismatch. As customers start piloting Agentforce, they immediately pause human hiring. They slow down seat growth to wait and see what the efficiency gains look like.
Okay, so legacy bookings slow down right now.
Right now. Meanwhile, the consumption revenue, the tokens and credits, that typically scales slowly at first before the usage really accelerates.
So you get a gap.
You get a gap. A temporary air pocket, a lull in total bookings growth, as they wait for the new consumption-based revenue model to scale fast enough to compensate for the lost license growth. The current 9% growth rate is likely, at least partially, a reflection of them navigating this air pocket.
As if that internal transition wasn't enough of a challenge, we have to address the external pressure from the most potent competitor in all of tech, Microsoft.
Always Microsoft.
What makes the Dynamics 365 and Copilot strategy such a dangerous threat?
Microsoft's threat is twofold and highly potent. First, it's the classic bundling strategy. Microsoft can offer Dynamics 365, their CRM suite, as a good enough alternative, and they bundle it tightly with the ubiquitous Office suite, with Teams, and with the massive Azure cloud infrastructure.
And the deeper danger here lies in IT budget allocation, doesn't it? It's not just about features.
Precisely. This is the crucial missing detail for many people. Large enterprises often have massive, non-negotiable Azure consumption commitments. It's a use it or lose it model.
They're already on the hook for billions to Microsoft.
Exactly. So adding Dynamics 365 and Copilot licenses often costs the enterprise virtually nothing at the margin because they are already paying for the underlying Azure capacity. This is an enormous subsidy that Salesforce, as a purely application layer provider, cannot possibly match. It puts immense downward pressure on CRM pricing across the board.
And the second threat is the disintermediation threat from Copilot itself.
That's the long-term existential risk to the Salesforce user interface. Microsoft's Copilot is being integrated directly into the Windows operating system layer, into the Office suite, into Teams.
It's everywhere.
It's everywhere. So if a salesperson can simply ask Copilot, hey, what is the status of the Acme Core deal? and Copilot retrieves and manages that data without the user ever having to log in to the distinct Salesforce user interface.
Then Salesforce just becomes a database.
It gets reduced to a back-end data repository. The perceived value and the user interaction shifts to the Microsoft OS layer, effectively disintermediating Salesforce's primary user touchpoint.
That's a serious competitive headwind. Okay, let's wrap this section with the bullish leading indicator that suggests Agentforce is succeeding in overcoming these risks.
Okay, the most crucial financial signal here is the current remaining performance obligation, or CRPO.
CRPO.
This metric represents the backlog of contracted revenue work that has been sold but not yet recognized as revenue, that they are obligated to deliver over the next 12 months. It's a forward-looking metric.
And what did the CRPO figures show this quarter?
CRPO grew 11% year over year, reaching a massive $29.4 billion.
Okay, so let's pause on that critical divergence. The backlog, the CRPO, grew at 11%, but the recognized revenue grew slower at 9%.
That divergence is the key bullish signal. In the software industry, when backlog growth accelerates faster than recognized revenue growth, it often portends a future re-acceleration of top-line revenue.
So it's a sign of good things to come.
It's a very strong sign. This divergence strongly suggests that the Agentforce consumption model is indeed beginning to fill that air pocket we talked about. It indicates that Salesforce is successfully signing new, larger multi-year contracts driven by Data Cloud and Agentforce adoption, signaling a potential uplift in growth, likely starting in fiscal year 2027.
The numbers suggest the Agentforce bet is landing, but the discipline that enabled this profitability didn't just appear overnight. It was forced. Let's move to Section 4, focusing on the financial and management turnaround. This is the story of the uncoiling P&L.
That's a good way to put it. Historically, Salesforce was just infamous for its bloated expense base, what was often referred to internally as the champagne culture of Silicon Valley hypergrowth. Their cost structure optimization has been ruthless and profound over the last 3 years.
We know the gross margin always looked elite, right? It was always sitting in the high 70% range, so where was all the fat located?
Almost entirely in the operating expenses, and specifically in one category, sales and marketing, S&M. This expense category was historically astronomical. It would routinely run at 45% or even more of revenue.
Which is just unsustainable for a mature company.
For a mature software company, that is highly, highly inefficient.
And what has that trended down to as a result of this big efficiency drive?
Management has successfully compressed S&M down into the 30–35% range. And this was achieved through really rigorous optimization.
Like what? What did they actually cut?
They rationalized global real estate holdings, which means vacating entire floors in city centers. They drastically cut back on the exorbitant costs associated with massive brand events like Dreamforce. And crucially, they optimized sales territories to rely less on expensive, high-commission account executives for simple renewal processes.
So getting more efficient with the sales motion itself.
Exactly. And this margin expansion is defined by one core concept in finance: operating leverage. Operating leverage is the defining trend of 2023 through 2025 for this company. Salesforce demonstrated that by holding its fixed costs, things like headcount after the initial restructuring and reduced real estate commitments, by holding those relatively flat, while revenue continued to grow at 9% to 11%.
The margins just explode upwards.
They expand dramatically. This proved the business is inherently highly profitable once the aggressive, unrestrained investment taps were finally closed. The operating leverage story is essentially the proof that they didn't cut muscle, they just learned how to sell and operate much more efficiently.
This kind of shift required immense leadership change. Let's talk about the management dynamics that drove this. Mark Benioff is the visionary, but who is the operational enforcer here?
Mark Benioff is absolutely the charismatic founder and product visionary, and he recently consolidated power by ending that weird co-CEO structure.
Right.
His strength is the narrative, but historically his weakness was operational discipline. To balance this, they brought in some serious financial firepower.
Enter Robin Washington.
Robin Washington was appointed as President and CFO Chief Operating and Financial Officer in March 2025. This was a critical signaling move.
Why her specifically?
She is a seasoned veteran. She served as CFO of Gilead Sciences, a company that is renowned for its rigorous financial stewardship, its discipline, and its immense profitability. Her move from being a lead independent director on the board into a direct operational role, it signals an unambiguous, deep commitment to financial rigor, and that was mandated by the board.
And this commitment was enforced by external pressure, which leads us to the board refreshment story.
Yeah, the board underwent a massive refreshment in 2023, and it was largely driven by pressure from activist shareholders. They brought in heavyweights, most notably Mason Morfitt from ValueAct Capital. The whole composition of the board was specifically redesigned to enforce capital allocation discipline and prevent a relapse into the aggressive, wasteful spending habits that were commonplace before 2023. This board now serves as a high-powered accountability committee.
The activists aren't just satisfied yet, though. The source material notes that starboard value is still very much present.
That's right. Activist investor Starboard Value aggressively increased its position again in Q2 2025.
Which is interesting.
It's very interesting. They originally initiated a position and sold some during the rally, but their return and their increased stake suggest two things. First, they believe the efficiency story is incomplete and there is more margin to extract.
And
Second, they believe the market still significantly undervalues the turnaround. Starboard's continued presence acts as an effective, highly motivated governor on management spending decisions, ensuring they remain fiscally responsible.
the most dramatic shift in capital allocation discipline is undoubtedly the share buyback shift, which was specifically designed to deal with that SBC problem we talked about.
This represents a total philosophical shift for Salesforce. They moved from a focus on M&A to a focus on returning capital to shareholders. The board authorized a massive $30 billion share repurchase program.
$30 billion.
And the strategic intent here is crystal clear: to fully offset the annual stock-based compensation dilution, which was historically eroding shareholder value by 2% to 3% every single year.
And has that strategy actually succeeded in offsetting the dilution? Have the buybacks worked?
It has been highly effective. Shares outstanding peaked near 1 billion in 2022, largely due to the equity they issued for the Slack acquisition. But they have now successfully executed enough buybacks to drop the shares outstanding to 952 million as of 2025.
So a 5% reduction.
A 5% reduction in the share count, which directly and non-controversially boosts earnings per share. It's a direct reward to shareholders for the operational pain of the restructuring.
Finally, a brief yet important detail on management accountability. The say-on-pay vote in 2024.
Yeah, that was a significant and very public rebuke. Shareholders voted against the executive compensation plan.
Even though the company was turning around.
Yes. This occurred despite the operational turnaround and the margin expansion, largely because Mark Benioff's compensation package was reported at $39.6 million in a year that was characterized by major layoffs.
So it's just bad optics.
Terrible optics. And this rejection highlights the continued pressure from huge institutional holders like Vanguard and BlackRock for executive pay, especially those large equity grants, to be strictly aligned with verifiable shareholder returns, particularly coming out of a cost-cutting cycle. It just reinforces the theme that accountability is the new normal.
We have established Salesforce as a disciplined, cash-generative machine facing an existential AI threat that it is attempting to monetize through Agentforce. Now for Section 5, the value investor's lens and valuation. How does a framework designed by the likes of Graham and Buffett apply to a modern subscription-based tech behemoth?
It forces us to distinguish between traditional deep value and what you might call quality compounder investing.
Okay, what's the difference?
The traditional 20th century value criteria, which rely heavily on assets, low P/E ratios, tangible book value, they just don't fit a pure software model. There are no factories to count. But the principles of durable competitive advantage and cash generation, those still hold true.
Let's apply the rigorous Buffett-style checklist then and see where Salesforce falls short first. Where does it fail?
It fails the strict deep value tests immediately. The price-to-earnings ratio on a GAAP basis is still around 34 times. Buffett historically preferred companies trading at 15 times earnings or less.
Not even close.
Not close. Price-to-book ratio is between 3.7x and 4.1x, far exceeding his conservative preference of 1.5x. And furthermore, the GAAP EPS record, because of all the M&A and SBC, has been choppy. It's not that smooth, predictable upward line of earnings consistency that he seeks.
So on traditional metrics, an orthodox value investor from the 70s would just dismiss it out of hand. But where does it pass, cementing its quality status?
It passes the quality metrics with distinction. First, it passes the moat tests, which we discussed thoroughly. High switching costs, network effects, and data gravity create very durable advantages.
Right.
Second, it passes the balance sheet safety test. Debt to equity is a fortress-like 0.14. It has virtually no reliance on financial leverage. And most critically, it passes the cash flow generation test with flying colors.
That is the modern definition of quality software, that cash flow.
Absolutely. The free cash flow to revenue margin is currently 32.8% on a trailing 12-month basis.
Yeah.
For a mature business with high recurring revenue, this far exceeds the typical 5% FCF hurdle rate used for software companies. Salesforce is a prodigious cash generator.
So the verdict is that it's not cheap by old metrics, but it is extremely high quality by modern ones. It's a quality compounder.
Correct. It aligns perfectly with Berkshire Hathaway's modern holdings, like Apple, which are valued not for being statistically cheap on a PE basis, but for their consistent, recurring, and massive cash flow generation, coupled with excellent capital allocation discipline shown through share buybacks.
To quantify this quality, we need to run the discounted cash flow, or DCF, analysis. Let's briefly explain the assumptions we use to determine intrinsic value.
Sure. A DCF models the present value of all of a company's estimated future free cash flows. We used an 8.0% weighted average cost of capital, or WACC, which is a common, reasonable figure for a mature, large-cap software company with low debt.
And for the long-term growth.
We used a 3.0% terminal growth rate, which basically assumes they grow just slightly above long-term inflation in perpetuity. And for reference, the current trading price is hovering right around $240 per share.
Okay, let's run the three scenarios based on the success or failure of the Agentforce pivot. Start with the most skeptical view, the conservative scenario.
This is the AI disruption bear case. Here we assume AI leads to significant seat compression and Salesforce fails to scale the consumption revenue model fast enough to offset that loss. We project a very sluggish 6% FCF growth over the next 5 years.
And what value does that give you?
Discounting those conservative figures yields an intrinsic value per share of approximately $241.60.
Okay, stop right there. Here's where the numbers meet market psychology. At the current trading price of $240, Salesforce is priced exactly at its conservative intrinsic value.
That is the single most important takeaway from this entire analysis. The market is pricing in zero success for the Agentforce pivot.
It's pricing in failure.
It is pricing in the fear of Microsoft bundling, the risk of the air pocket, and the possibility that 9% growth is a ceiling, not a floor. The market is essentially saying, we believe in the current cash flow, but we are terrified of all the competitive and structural risks.
So the current valuation already accounts for significant disruption. Now let's move to the nominal scenario. This assumes a soft landing, where management just executes on their stated targets.
This assumes Agentforce successfully offsets the seat loss, and it returns the company to a sustainable, low, double-digit growth profile. This aligns with management's own goal of achieving around $60 billion in revenue by FY30, implying about a 10% FCF growth rate over the next cycle.
And under those reasonable base case projections, what's the value?
The intrinsic value per share comes out to about $336.87.
That's a huge delta. If they just manage to meet their own reasonable discipline guidance, the stock looks significantly undervalued.
It suggests approximately 40% upside to the current fair value, just assuming management executes this pivot successfully. The market is providing an asymmetric risk-reward profile. Meaning you're paying a fair price for the conservative bear case today, but you get the potential of the nominal base case almost for free.
And finally, the ultimate optimistic scenario, the AI winner bull case. What happens if everything goes right?
This assumes Agentforce becomes a massive additive new revenue layer, that the digital labor economy really takes off, and that the structural margin expansion continues, pushing FCF margins up toward 40%. We project FCF growth re-accelerates to 14%.
And the value in that scenario?
Under this highly successful outcome, where they truly capture the AI upside, the intrinsic value shoots up to $469.11 per share.
Wow. The valuation conclusion is clear then. At $240, the market is completely skeptical of the growth narrative. The entire investment decision hinges on whether you believe management can deliver on the nominal scenario of 10% FCF growth.
Precisely. You are buying an extremely high-quality, cash-gushing business at a price that reflects deep fear, even though the company has proven its operational discipline and its cash generation capability. It's a classic quality compounder situation where the upside is potentially massive if they simply meet reasonable expectations.
And that brings us to the synthesis of our deep dive into Salesforce. We've witnessed the complete life cycle shift, trading the chaos of hypergrowth for the rigor of hyperprofitability. The investment thesis today hinges entirely on the Agentforce consumption model overwhelming the risk of AI-driven seat compression. They've proven they can be disciplined and execute cost cuts. Now they must prove they can innovate monetization.
And if we connect this back to the bigger picture, the shift from charging for human labor, one license per sales rep to charging for digital labor, 1 credit per 1,000 tokens processed by an AI agent. This marks a fundamental change in how all enterprise technology is going to be monetized. This is a crucial transition to watch.
Here's the final provocative thought for you to mull over. We've focused so much on the risk of seat compression, the downside, But think about the potential leverage on the upside. If Agentforce succeeds, the increase in operational efficiency will allow Salesforce to permanently lower its own internal cost structure, driving S&M down even further, while simultaneously generating new consumption fees from their 150,000 existing, already locked-in customers.
Which means the current high FCF margins might not be some cyclical peak, they might be a structural baseline.
Exactly.
If Agentforce allows for massive customer efficiency, Salesforce could transition from a mature 9% growth company back into a high-growth platform. And that growth would be driven entirely by unlocking efficiency and generating immense usage fees, not by finding new logos, but by driving deeper engagement with the ones they already have.
The big question remains, will they successfully monetize this digital labor, or will Microsoft take the spoils?
That's the multi-hundred-billion-dollar question.
Thank you for joining us for this deep dive. Remember, the analysis we provided is purely for educational purposes and does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
And for those of you who want to access more advanced content and continue these deeper discussions, you're welcome to join our Deep Value Club membership. And, if you're interested in tracking the broader macroeconomic context for these kinds of valuation plays, how to gauge when the overall market is priced for perfection or pricing in significant fear, you might want to search for and download our iOS app, the Buffett Indicator, from the Apple App Store. It's a useful tool to keep a pulse on things.
You can also subscribe to us for more advanced content on Apple or Spotify Podcasts channel, Deep Value Investing. We'll see you next time.